Hi, good afternoon, everybody. Thank you all for joining in. Uh, so my translator Swagath is little tied up. So I will be doing this in English, but I think he will come in for Q&A, where he can take up questions and he can do his best to answer in Tamil. I won't be able to do my best to answer in Tamil, but so I'll take up most of the English part. I'll keep it very simple for all of you to understand. And he'll join in, once certain things get in place, right? So we'll wait for another 3 minutes, and then we'll start. Yeah, we'll wait for more people to join in. Just give me a thumbs up if everything's all right, sound, video, everything. Perfect. Okay, so I think let's start. It is somewhat of a long presentation, but I'll skim through it. We'll only look at the most important stuff, uh, so that you will be able to understand most of the things of what's been happening and what we're trying to do in 2025, right? So it's a good refresher on what's been happening. See, in 2010 we were talking about globalization, and after the crisis we went to deglobalization, and this is what it looks like. You're having more trade wars, you're having tariff wars. Everything is disconnected to each other. Central bank policy, that is, they are not following that of the US. So this is what deglobalization looks like. So it's everybody for themselves, right? We went from zero interest rate, which is monetary easing free, to monetary tightening, which has made it difficult for growth. And this is why you see that we are in a very tricky situation for growth, right? So we are staring at a slowdown. It's not that we are in some parts are in slowdowns, but yes, you are staring at a broad-based slowdown, right? And with the new president that has come in, so you are seeing that policies also are going to be very aggressive in nature, which is going to lead to sticky inflation. So we went from stable inflation last decade to this decade being more of a sticky inflationary sort of a environment, right? And you're having high interest rates, right? This scenario does not bode well in terms of global growth, right? India is separate. In terms of global growth, there is a lot of risk when it comes to a slowdown, sticky inflation, and a high interest rate scenario. Right. So these are all proof to say that yeah, things are looking more from a on the riskier side on the global front. Like you see interest rates, you see a sharp rise from zero all the way up. And now if you see on the right, you see the Fed balance sheet expansion, right? So printing money in financial crisis. And after that, you had a very sweet period where you didn't have any sort of crisis. But when the minute they started tightening, things started to get difficult. Right, that was one. Then COVID happened. Then one more print. Then you had in high, very high inflation. You're still having high inflation, sticky. So whenever there is a tightening sort of a scenario, you see crisis over crisis. You had the rupee market blow up. Now, then you had the Silicon Valley Bank crisis. So always go with that assumption that when money comes out of the system, you do see certain risks panning out, and they are playing out, which is very harmful to wealth creation. It is very harmful. It destructs it. Very destructive in nature, right? So the global environment that we are operating in is more on the riskier side, right? So let's look at inflation and what has been happening to inflation. Inflation has been on the higher side. It has been very sticky. And growth, if you see on the right side, growth is very moderate. It's not high, it's moderate, right? So that is why we are saying that, there we are staring at a slowdown, but that doesn't mean that everything will be bad. Certain parts will be very bad, certain parts will be very good. That's why we cannot take a broad based call when it comes to investing money right now. Right. So if you look at globally inflation, right, India is fairly doing very well. The expectation for India also that it will do very well. You look at UK sticky. You look at Japan. Japan went from a no inflationary, deflationary environment to a high inflationary sort of. They've not seen this in a long time, nearly 3 decades. Right, 2% odd. The expectation also is that. US again sticky 2%, 2.5%, right? But again, sticky part. So it's not that inflation will come down, but it's just that from a headline number, it looks very low. But household inflation is very, very high. You see cost of living in developed nations to be skyrocketing. Right? Likewise, in India, your household inflation will be somewhere around 11 to 12%, depending on how your particular lifestyle is. But the whole point is that we were operating in an environment that was where price increase was very high. We are going to be in an environment where price increase will be high, will remain. Right? Might not go high, but will remain. Now, in this scenario, India is the only country that is offering you 6.5 to 7% GDP growth. Right. So if you look at any other country, what has happened, the world is somewhere between 3 odd percent. US has been below. See, developed nations, right? They are somewhere below. They're not performing very well. So this is the era for emerging markets, and we all know that yes, emerging markets are where investors should be right now, particularly on India. So India offers 7%, which no other country is offering to the world. So yes, expect that whenever you get opportunities in India, you're not going to get it very, very fast. So if you saw election, 2 days worth of correction, you didn't get an opportunity after that. Again, now during the US election, you got an opportunity. Now again, after Fed rate cut, you're getting an opportunity. Right. So whenever there is opportunity that comes, you need to capitalize very, very fast. And if you're on the platform, you are already getting messages from a side. Your point of contact is in touch with you to tell you that yes, now is a great time for you to capitalize on the market. Right. Now let's look at performance. See, performance last year was very good for Nifty 50, Nifty 100, small mids, definitely. Now you're in a scenario where things are not looking great. So Nifty 50 this year has somewhere around 11%. Broader indices are somewhere between 15 to 16%. So now I'll ask you a question. Apart from small and mids, what has beaten equity market? You can put your comments in the chat box.
Harshil, I think you're on mute. Can you check once?
Yeah, sorry. So what I was talking about was that see, gold over years has done phenomenally well, and we are very big advocates of gold. 18 did well, 19, 20, 21, 22. Across all right, it has held its value and it has shown growth. Now, how much is the return for Nifty from a CAGR perspective over the last 5 years? How much would that be, according to you? No? See, gold is outperforming equity market, right? You see gold's return on a CAGR perspective since its inception, since 2000, right, which is 23 years, 24 years, is somewhere around 12%, which is a phenomenal rate of return. Yeah, equity will somewhere be between 11 and 12 or 12 and 15, depending on the active part, but the benchmark on a longer term usually is somewhere between 10 and 12. So for a risk-free asset class, you are able to make much more. You're subsequently taking lower risk, plus you're getting very high return. So we believe that a multi-asset approach in 2025 and 2026 would work very, very well. We have been advocates of multi-asset since 2018. We continue to believe that multi-asset is the way for us to go. But we are not going the multi-asset fund route. We are sticking to uh, uh, pure play, which means that we would like control of how much we want to buy of that particular category. Not a rule to say that no, you need to do only this much. No, there are times when you should do much more. There are times when you should do much less. Right. So going forward, we believe that a multi-asset approach would definitely work well. So now how do you create wealth through mutual funds? Now, this is a very important slide because we are always caught up in how much return somebody else makes versus what I'm making. You usually go and compare yourselves to your friends or family members to say that all my friends have done very well, I didn't do very well. Now I want to invest to do very well. See, the point is it's not when you start, it's your behavior. It's how your journey is. So the difference in return between you and somebody else is not what they bought, is not when they started, but it is from a behavioral aspect, right? Somebody who's consistent, somebody who's disciplined, and somebody who is increasing participation levels, when things are not looking good, will obviously have higher return than that of somebody who's trying to time it to the exact moment, right? Why? Because you are able to build and contribute to your wealth creation journey in a bulk over long phases of time, which ultimately lead you to higher returns in the future whenever you have a goal to meet. But the difference does not come from when they started and what they bought, but it's more from a perspective of behavior and what and the kind of behavior you show when you are on the pitch. Right. Today, test match, you saw big players are not able to perform with pink ball. Big players are not able to perform on that particular track. Right. If they are attuning themselves to that pitch, if they are able to attune themselves to a pink ball, then naturally they will perform very well. So your job itself in the first 5 years, and this is where we come in and where we actively work with you, is to get you seasoned as a saver so that your first 5 6 years you're able to go through a particular cycle, you see how things are running, then you start getting confidence to do more. You see you've also grown in your life, you see what the potential is, you see how much if you go about saving, how much would you ultimately uh, build as a corpus for your particular goal, let's say retirement. Naturally you will strive to do more. Right. So our job is to help you, handhold you, and season you so that you get your behavior right. And after that, you are on autopilot. Right. Though, yes, there will be good intervention that comes. But the whole point is that first 5 to 6 years is where your actual you get seasoned as a saver, which will help you to capitalize on the next 15 years of India's growth story. Right. That's the difference. It's not when I started investing, it's not where I invested, but it's more as how you are actually going out and investing. Right. Now, this is a very big theme for us to look. See, we looked at what's been happening globally. We know that India is on a growth path, right? But where that growth path is usually going to. Today, we are in a scenario where small and mid caps have gone beyond valuation range. You will not get right now an opportunity to do small and mid caps. So, no point chasing something. Right? So, we usually do not try to chase. We look for the next opportunity and the next idea and the next idea so that as a saver, you be consistent and you leave the research part to us to say where to, when to, where to, when to next, all of that. Right. So now if you see large cap funds, they have gone out of favor. Now, why is it that they have gone out of favor? Right. See, there was a SEBI recategorization that took place in 17 that said that no, top 100 needs to be large cap. So naturally, what happened after that is if something was not in the top 100, that entire segment had to be sold off by fund managers. right? That led to underperformance, and that led to a change that once the change takes place, it takes time for the change to get digested in the system. And large cap as a category is quite large. It's huge. See, between Nifty 500 top 50 itself is 43%. So it is so when such a shock comes, it takes some time to digest for the entire industry. And if you see what happened after that, your percentage of large caps schemes that started to outperform the Nifty started to go down. So this is clear evidence that yes, after this, there was a problem. So you see 18, 19, 20, 21, the money that they were making up and above the benchmark was low. So you see that things are going in that direction where they are struggling to make a change. Today we are in a scenario where that change has gotten digested. Today you are having almost 70%, 65% of large cap schemes that are outperforming the benchmark. So there's a significant change that has taken place, right? If you see 30 over the last 1 year, 33% itself. The only that has underperformed the benchmark. The rest, 60 odd percent, 65 odd percent is outperforming. So yes, there's a lot of change that has taken place. But if you see historical data, history will tell you something that yes, this segment has not done well, so not to look. But things are changing very, very drastically. And today, as a saver, we would say that the opportunity now lies in the larger companies in India. See, from a valuation front also, on the large cap space, you are having enough margin of safety. So if you compare it to a mid or a small, so the next opportunity lies here because you are not paying more for it. Plus, if India has to grow at 7%, your larger players, your large corporate India need to contribute a lot to that particular growth, right? So two things are working very well: getting it cheap and high growth potential. And this is why we believe that. And if you're on the program, if you're on the platform, you would have gotten multiple, calls from our side that yes, you should be doing this in nature. But taking a broad-based passive approach might not work for you, and hence things have to be tailor-made for you. So for your particular goal, based on your risk appetite, we will tailor-make solutions for you, right? But I'm giving you a broad-based idea of what we're looking to do, right? Second, India is very aspirational. You're seeing for 7% growth rate, and you're seeing the number of households that were in the lower middle class category are now moving to upper and upper middle class. As India as a country starts growing, you see that yes, the income levels start going up, and then everybody, you see from a see the pyramid. That pyramid is now some other shape, right? Where you're having a big chunk coming in upper middle class. So income levels are going up. And if you see how much we are spending, right? For us, FMCG per capita consumption, which is how much we are spending on consumption, is very, very low compared to other developed and developing nations. You look at Indonesia, look at China. Indonesia is a smaller country to us, and they are also growing at almost similar rates, but they are consuming more, and we are not. You look at Thailand, look at Philippines. You see, they're all smaller than us, but they're not consuming more. So India as a country is large. We are growing also for this size of a country. We are growing phenomenally well. So naturally, as income levels goes up, our consumption patterns, the way it's changing, we will start to consume more. Right. Here, if you see our per capita is somewhere between $2,000 odd, $2,200. The minute it crosses $3,000, it's ramifications from there. Right. After that, the next thousand and the next thousand after that is it's like compounding. Right. Is very, very easy to go and achieve. Right. But the whole point is that our consumption patterns are changing. One, our income levels have gone up. Two, and third, we are spending less. So you will see that as we start earning more, you will be spending more on discretionary consumption. So naturally, consumption becomes a very, very big theme for us. And if you say consumption right now, FMCG sector, YTD returns will be somewhere between 3 odd percent. Last 1 week, it has been on a tear. So yes, it's a great point for us to look at in terms of what to do in 2024, 2025. Right. Now, the third is banking. Now, it's not pure play banking, it's more from a financial services point of view, where where the fund does invest in AMCs, exchanges, depositories. So basically, it's a 4 lakh crore PAT opportunity. right? And if you see growth rates have been phenomenal. For us to go out and start spending on infrastructure, your banks need to be in a very good shape. So yes, a major chunk would come from the banking side, but we've had more listings that are AMCs. Basically, the opportunity size has increased for us to go out and invest. So we should take advantage of this because banks are very critical to a growing nation that aspires to have the 7% or sort of growth rates for the next 5 to 6 years. That your lending space and your lending capacity needs to be very, very strong. And from 18, things have been changing very drastically. Your banks, after a crisis, DHFL and ILFS, you had the banks recapitalizing themselves. The government supported, loans were written off, NPA levels were high, then it went down. Lot of things are working on that entire front from banking and financial services. Right. So three things, right? One is large, the other is consumption, and the last one would be banking. So you see, these are data to show that yes, things are looking good on those fronts. So 2024 was a year where we were able to take uh, some sort of risk on small and mids, but going forward, we don't think that that level of risk would come because macro fundamentals are deteriorating and they don't seem to have a very large scope for improvement. So we are staring at a slowdown. We'll come to know next month as to what the president wants to do and how it is going to impact global scenarios, whether tariff wars would affect, trade wars would come in. But we are in a very tricky scenario outside. In India, we are spending well, but we are again seeing urban consumption slow down. So you only have to look at it from a margin of safety point of view as to where investors need to go and start saving money for this particular cycle. Then when the next cycle comes, you will obviously have other opportunities. So the winners in the previous cycle are not going to be winners in the next one. Losers in the previous one are not going to be losers in the next one. Right. So this is what we have as a outlook for 2025. So how can Milestones2Wealth achieve you? Help you to achieve a crore. See, the whole point is one, we will help you to do more. One, we will help you understand what your potential to save is, right? What you're currently saving and what your potential to save is. Right. Staying invested is on you because you have to be consistent, as a saver where financial assets are we went from a physical asset to a financial asset sort of a transition where the previous generation was doing more physical and now it's going to be more financial. So it's your job to make sure that you show patience and you keep staying invested, right? Being consistent matters a lot on your part. From our side, what we will help you do is that we do so there are multiple checkpoints. One is we ensure that your insurance is covered, whether you're over-insured or you're under-insured. Second, and this is all part of the financial health checkup. Second, we help you take a risk profile test where we understand, your ability to take risk and your willingness to take risk because there's two separate things. You might have deep pockets, but inherently your personality is quite conservative. You might have a shallow pocket, but your ability to take risk might be very high. Willingness, right? So we do all these checks and educate you on what sort of a saver you are. And second, when it comes to understanding your expenses, we help you maintain a high savings rate ratio. Sometimes you might have a 30, 34, depending on the loans and liabilities that you have. This is where understanding your potential and growing your potential comes into place from our part, where we help you meet your particular goals so that you have certain liabilities, so that you have more money in hand to start saving onto financial assets. So we help you understand how to grow your savings ratio and how to maintain that particular growth. Right. So how do you get to a crore, right? So this is the behavior model. See, Milestones2Wealth loves to take advantage of boring markets. So we are heading into a place where it's going to be very difficult for investors to understand. Okay, they cannot take a broad-based approach now. Now you have to be very concise and concentrated in terms of what you should do. So this eventually is going to look like a very boring market and you will be caught off guard because you will not know what it does very well. Right. So again, it will be chasing performance. But what we do is we try to preempt it by making sure that you are able to participate in a very extremely valuable parts of the market at right times. So lump sum SIP step up is our approach. So some teams will have more lump sum, some teams will have, some ideas will have more SIPs depending on what the valuation range is. So for example, consumption, right, is it's leading on to more lump sums now, but at the start of the year, it was more SIPs. So you will always get opportunities to participate in the market. And your job is to make sure that you are actively working on maintaining a savings ratio that is high, it is somewhere between 65 to 70%, so that you are able to participate in all undervalued parts of the market. Right? Exciting market benefits come only when, one, when valuations go up, second, when you're very close to meeting a particular goal. So when you're very close to meeting a particular goal, naturally we have to take out money off the table. And if valuations are extremely high, say for example, infrastructure, which is what we did, we took some money off the table to ensure that you are having a stable, consistent wealth creation journey. You are not on the riskier side of things. We are always here to mitigate risk, right? So now, let's say if you are doing, like, how long does it take you to reach a crore? If you're just doing 70,000 every month, growing at very nominal rates, uh, it takes you about 7 to 8 years for you to get to your first crore. But then for your next crore, it takes you 4, and the subsequent crore after that is 2, then 2, then 1. So by the time you reach your 20th year of investing, you're adding at least a crore every year. So our goal is that when we say that you need to have that target of 1 crore, we are actually setting you up for a 10 crore sort of wealth creation journey, right? By making sure that see, this is a saving in financial assets, which is more equity in nature, is a risky venture, right? But mutual funds have done a phenomenal job of making sure the volatility is lower. And when we put on a multi-asset sort of approach, we say that yes, you are taking less volatility. There is stable growth rates that come. So that approach works for a saver in India, right? Uh, but that 1 crore is when we see things from a 1 crore perspective. We are seeing only things from a 10 crore perspective, not for a 1 crore perspective. So when you are on that goal for a 1 crore perspective, that's why we have multiple checkpoints. That's why we make sure that your first line of defense is covered so that you can be aggressive on all the other fronts. So for us, in our mind, when we are working with you for a 1 crore sort of journey, we understand that, yeah, no, it's not 1, it's 10, so that you're able to meet your goals. Uh, you can retire stress free. You can do whatever you want with that particular corpus. But it's very clear in our mind that when we are setting a 1 crore target, it's not 1. We are working for 10. Right. I think that's all I have from my side. So I think I can open the floor for Q&A.
Harshil, hi, we have quite a questions here.
Read it or you're
Okay, so there's a question on any idea why the consumption got reduced in urban in recent quarters. Uh, See, inflation is definitely hitting. So you are seeing in one part where discretionary spending is high, and you're seeing in one part where the patterns also keep changing. And we've seen that uh, just in terms of inflation, one, it has been a hit, and second, there are patterns that are being changed. It's not drastic changes, but yeah, there are certain parts where uh, you're spending more, and that usually takes a hit. So you are in a place where you have to decide whether you want more essentials or you want more of this. But don't worry, essentials will always take priority. See, we are taking a broad-based approach to consumption, not just sticking to FMCG. Do you think the market will be volatile in the coming days? Yes, market is already volatile. We have been preparing ourselves and all the investors that we're working with, that markets are going to be volatile for the entire year. We expect it to be volatile in the next year also. And don't see from a percentage drop, percentage increase sort of levels, but you only see based on, okay, today valuations are at this level, and where am I running the risk? You're running the risk majorly in small and mids, and on the larger side, you're not running that high of a risk, but there are certain parts there also which are not, for earnings growth, you're paying more. So naturally, you take that decision to say that, okay, I will be prepared to participate every time. So don't try to time the market from your side, because we are already making sure to time things very well. Is there any specific large cap fund in employer I've been suggested mainly focused? Yeah, that's what we are doing. See, even on the large, we are trying to be very concentrated. So that's what we're doing. Swagath, do you have anything to add to that?
One second, Harshil. Yeah.
I'll take the next one of how gold will be impacted. See, this cycle has been very interesting for gold because it is dealing to the dollar. So the dollar is also strengthening, the gold also is strengthening. And usually a Fed rate cut is good for riskier asset classes, particularly commodities. So we are very bullish on the gold side, and not from a cut perspective, but from an inherent volatile condition, because global growth is faltering and inflation is quite high. So, there's a very big risk to currency. So naturally, we will go more towards a currency and look for an alternate currency that can hold value, so that it can be used, if for equity or debt or anywhere else. Basically, we want to hold the value of a particular currency.
Harshil, can I just
Yeah, take
tell
it.
you my
Please take it.
question? Yeah, so I think Mr. GS has mentioned that he's been suggested only focus funds from his NTW contact. Yeah, I think it would have suited his risk profile, and that's why we would have done that. And at the same time, there are few large cap funds which we are also added. And I think when we give a lump sum call, I think that can be added as well. If it suits his profile, that's my opinion. So I think if his contact or if he reaches to his RM, right? So I think it should be helpful.
Yeah. See, and everything comes from a centralized team. Nothing is based on that particular person. So it's all research backed. Everything comes to you from it's a decision that the team takes, and it then comes across. Okay, for this particular, say for you, based on your risk profile, based on your goals, this particular strategy suits for you. So we will go ahead and do that for you. So it's all tailor made. It's all one-on-one that takes place. There are 3-4 teams at work. Yeah, one is strategy, the other one, which is with the team that I'm in. There is planning that is involved in this. There is insurance that is involved in this, because we have checks, right? I told you there are checks. And then comes your point of contact, which is our growth accelerator, right? So there are multiple teams that work on a particular portfolio, which you will not get if you're just doing direct and you're just doing it with a banker. So it's all research backed. There's a good amount of work that goes in it. 4 teams work on it. No, other asset classes also. M2W will help in investing. We are doing others. We are doing a multi-asset approach. Swagath, do you have anything to add to how we are doing multi-asset?
I was saying, so we have a multi-asset approach where we are, at the moment, we've been adding gold and silver, but at the moment, again, we've called in, for cash in gold and silver. That's one thing. Secondly, it's not just about MF, it's about a wholesome, financial experience that we are trying to provide in M2W, where, your investment advisor will help you with, having a right insurance policies in place, be it a health insurance or a life insurance, or having a proper emergency reserves in place, so that when there is emergency, it's been taken care. ஸோ நான் தமிழையும் சொல்லணும் அப்படின்னா வந்து எம்எஃப் மட்டும் இல்லாமல் உங்களுக்கு இன்சூரன்ஸ்லையும் வரும். அண்ட் அகைன் கோல்டு அண்ட் சில்வர் அந்த மாதிரி மல்டி அசெட் அப்ரோச்சும் நாங்கள் வச்சிருக்கோம். ஸோ அந்த டைம் டு டைம் பொறுத்து அந்த அப்ரோச்சை நாங்கள் வந்து உங்ககிட்ட கொண்டு வந்துட்டு இருக்கோம். ஸோ M2W அப்படின்றது வந்து ஒரு எம்எஃப் பிளாட்ஃபார்ம் மட்டும் கிடையாது. இட் இஸ் அ ஹோல்சம் ஃபினான்ஷியல் பிளாட்ஃபார்ம் வேர் யூ கேன் ஹாவ் எக்ஸ்பீரியன்ஸ் ஆஃப் ஆல்.
Perfect. Okay, last week MF fund was suggested. Yes, you did a lump sum. I'm very happy. So naturally, you're a star investor when it comes to investing. Is it suggested for one time? No, it's a long. Everything what we do is long term. We are not a broker. We are a platform. It's more behavioral oriented. See, we try to capitalize on bad times by giving you such decisions. So it's not from a broker point of view. You keep getting messages from your broker to say do this, do that, do this, do that. No, we don't. The intent is not like that at all. The intent is to reach a huge set of society, huge set of audience that we work with. So, rather than waiting for somebody to call you, we are taking the decision on hand and making it centralized to say, no, we will send you a message where, and everything that we do is from a long-term perspective. So you'll keep getting opportunities. It's not for that day, it's all long-term. It's all 5 year plus. But that's a very, very good question. See, it's, how MPW, see, we are doing it based on your risk profile. You're doing it based on your goal. So depending on what your profile is, we will definitely do multi-asset, and we are doing multi-asset approach only. See, certain things will suit everybody, right? Like gold can suit everybody, right? Silver sometimes it cannot. So at a particular price point, it would be, yeah, it suits everybody because here the risk is very well captured. So you will get. So it's very dynamic. I have 50% money in US equities, basically 7. Is it time to book? Yes. Do you think, yes, it is overvalued, but they're able to give good returns, good growth? See, the thing is, it has been, see, today 30% of the S&P 500 is top 7. So 493 companies have not actually delivered good growth, somewhere between 11 and 12%. Right. So, there is a lot of bubble conversations that are taking place. So, as and when you see, such cases take place, try to take some money, de-risk yourself. And if you want, we can help you review also. So just get in touch with your point of contact and we'll help you review it. We do it. So we are already having a 401k review that happens. That is me and planning. That is basically the strategy and planning that work on this, where we will review your 401k, and most 401k money goes into only top 7, top 10. So that's a high risk, right? A lot of money going to the same place over and over again. Where have you seen this? Most money in India going to the same place over and over again. Has it reached its peak? In which case, do I need to wait or exit? No, we don't think that. See, precious metals is limited in nature. The industrial use cases are high for metals, and going forward also with more and more technological advancements that are taking place, metal use cases are going to go up. Thing is that it is low supply. Central banks also are fighting for demand. You see gold's demand coming in from central banks. So naturally, repricing is not on precious metals, it's rebasement. So inherent value of a particular commodity changes. There's no, we don't do short term, everything is from a long term perspective. You will get more opportunities to see. When we are doing this particular call, we are not doing based on a gamble. We are coming with solid backed research to tell you. And I've done multiple gold and silver webinars. And this is not today's call, it has been 3 years back call, right? Where we're continuously doing it. So there's a good amount of research that, and only after that it crosses multiple checkpoints from our side and only then comes to you. So there's no short term, there's no exit, there's invest mode, depending on your financial condition. Okay, about few shares yesterday, seems like brokerage has increased easily by up stocks. Will the same charges get applied by? See, mutual fund is a highly regulated segment. All you pay is expense ratio, and we don't have any costs. We only have the expense ratio that comes to us. There are maybe some account. There's no account opening charge also for us. It's all free. That's why we do it by ourselves here. We don't want to do it with any of the, because you have to pay them also. For us, there is no cost. It's all no account opening charge, no transaction cost, nothing like that. Like whatever is a normal STT, all that you will pay. That's it. I have joined Employee 6 months back, so I have missed past recommendations. That's okay. You will always get recommendations from above. You've not missed anything. Most most of the recommendations that we gave before stand hold today. So don't worry. And whatever we have been giving as in the last 6 8 months is actually here. I already covered the three things. So don't worry about. As long as you're with us, you will always keep getting high quality research backed recommendations. And they are proven. There's a proper track record to show that yes, we have done quite well. On the boring stock index, what do you think of Reliance, Coal India, Maruti? Boring stock index was a behavior. I'll tell you this one. Uh, when we did the exercise, I did not expect that so many people would be obsessed over stock names, but not obsessed over the sheer idea of how margin, when you do something with less margin of safety, with high growth potential, your returns are high. Right? See, this is what exactly we are doing on Milestones2Wealth. We are sticking to boring only. It's not that it's stock specific or anything of that sort. It's more from a behavior oriented that you as a saver need to be conservative, number one. And second, you need to be patient. This part. Staying invested and being patient. Right? You leave the conservative part to us. Staying invested and being patient is for you. We did this as an exercise to prove that you don't need to take very, very high risk in terms of small, mids, wherever valuations are very high. You don't need to chase performance to get performance. Right. So don't get too obsessed with the stock name. Right. But the whole idea is that conservatism works and staying invested, being patient, making sure that you're not doing things at the wrong part, wrong direction, chasing performance always leads to a good performance result. That's not the case. You will always have new winners. You will always have new losers. That's the whole intent of boring. It was never to give out see that you should do this a stock name. No, we wanted to prove that patience works and conservatism works. Where do I get stock research papers to understand stock better? Why do you want to understand stock better when I've already done the job for you? Shamsa says that if you are a full-time investor in stocks, you need to spend 5 hours daily. I don't think that you have 5 hours daily. Right? 5 hours to sit daily to sit and research. I don't think that given how uh, things will be for India and given how you will you are on your growth journey from a career perspective, so you will not have the time to do all this. So why do you stress about? That's my stress. The mutual fund industry is large, yeah, 60 lakh crore. Out of that, 50% or 30 33 or something would be 33 34 would be equity. uh, the industry is so large that you're getting high quality advice across the board at a very, very low cost. Your expense ratio is just somewhere between average would be regular would be 1.5% to 1.7%. So it's very cheap. Globally, developed nations, there the expense ratio is higher. You have management fees and you have all that other stuff also. Here, nothing you're getting, but you're getting very high quality work that is coming from a mutual fund itself. They have a big team of 16 17 analysts. Then there's an investment committee that vets everything to say that no, we should do this, we should do this, we should do this. So why do you want to layer something on and try to beat some experienced 20 25-year-old fund manager? with that experience, 20-25 years old experience. So I would always say that you work with somebody who can do the job for you. Yeah. There's no price. I mean, the price of you getting that large 20-year experience is very, very low. You get concerned about the change of fund managers. I see ICICI has a new fund manager for focus funds. That fund manager has been there for a long time. Change happened long back. Change of fund manager, yes, can work. I think at 11 when we did this presentation for active versus passive, there's a very good question on can a change affect? Yes, a change can definitely affect because new philosophy starts coming in. See, we went from a more DNA of a fund manager to a DNA of an AMC. So that is what the de-risk has taken place. That's why you're seeing the impact below. So that we would like to go with the DNA of the AMC rather than going with the DNA of a fund manager. The AMC should develop that DNA for the fund manager. So even if the fund manager goes away and they replace it with another fund manager, DNA is still intact. Style, yes, there would be some 1-2 quarter problem. We have seen cases where it has done very well. We have seen cases where it has not done very well. So of our universe itself, out of 4, for example, 3 have done well, 1 has not. This is from 17, 18, and 19. When you see from a long-term perspective. And not done well, not in terms of returns, but not done well in terms of, our expectation was completely different. So it's coming from a biased standpoint. Same, 1.5%. PMS charges for us, it is 1.5%. So we have 2 products in which the cost is 1.5%. The other 2 products are this, so that 2, one is fixed and one is variable. But by and large, right, we've kept it low. It's about 1.5%. That is charged to you annually, paid quarterly. What do you think of real estate? I'm not very well versed on the real estate part. I'm yet to cover a lot. I only know from a historical perspective what has been the growth rate. See, even if I want to buy a house, I know that it's quite expensive. So it will put a dent onto my savings ratio. So my priority would be to first build majorly on financial assets. If I get an opportunity, then real estate. But my understanding is very low of this. Okay, we'll keep the floor open for another 2 more minutes. And if there are further questions, very, very happy to address it. If not, then we can definitely close. What is the outlook for gold? Very, very positive. We think that there has to be an alternate to currency. It should not be equity versus gold. It should be currency versus currency. And we think that this currency can hold its value, can protect you from depreciation or devaluation in currency. Keep your purchasing power intact. Same. Commodities in general. Sorry. Okay. Do you think Reliance will bounce back? I see. I can't comment on stocks. I'm very sorry. Can you repeat the book name? See, Vinu suggested two book names. One was Masterclass with Super Investors, which is a fairly old book. 2018 it had launched. Uh, I suggested Mastering Cycles, which is by Howard Marks. It's a very good book that you can read. Psychology of Money is what he said. So these are the three names. Okay. All right. Done. I don't see any further questions. Done. Thank you so much all for joining in on a Saturday afternoon. Have a great weekend ahead. And if you're not on the program, get on the program. Just send us a hi. Our team will get in touch with you. And let's meet next week. Thank you so much, guys. Thanks.